Hey everyone, and welcome. Today, we are going to break down a really powerful tool that a ton of pro traders use, RSI Divergence. We're going to see how it can literally signal big turning points in the market before they even happen. So let's just dive right in and see how this thing works. It all really comes down to this one simple question. What happens when a stock's price looks like it's climbing higher and higher, but the actual force, the momentum behind that climb, is starting to run out of gas? That little disagreement, that mismatch, well, that's the secret sauce we're looking for. It's the heart of what we call divergence. So here's the game plan for this explainer. We'll start with the basics. What even is RSI divergence? Then we'll get our hands dirty and show you exactly how to spot it on a real chart. After that, we'll talk about something crucial, timeframes. Then we'll lay out a simple step-by-step strategy for a trade. And finally, we'll cover why RSI, as great as it is, should never be your only tool. All right, first things first, let's get a super clear picture of what we're actually talking about here. Okay, think of it like this. Imagine the price and the RSI indicator are two partners on a dance floor. As long as they're moving together, in sync, everything's great. The trend is strong. But the second they start moving in opposite directions, one zigs while the other zags, that's a huge signal. That's the market whispering to us that the music's about to change, and the trend could be losing its rhythm. Now, this slide shows it perfectly. This is your classic bearish divergence. Look at the top line. That's the price. It's making a new higher peak. Looks bullish, right? But now look down at the RSI indicator. See that? It's making a lower high. The price is going up, but the strength behind it is actually going down. That's the divergence. It's a massive warning sign that the buyers are getting tired. Okay, so that's the theory. Let's jump over to a chart and see how to actually spot this in the wild. And here's the flip side of the coin, a bullish divergence. Take a look at the price chart up top. It's making a new, scary-looking low. Your first instinct might be to panic, right? But hold on. Look down at the RSI. While the price just hit a new bottom, the RSI has actually formed a higher low. What's that telling us? It's saying the sellers are losing their power. The downward momentum is fading. This is the exact kind of clue that suggests a bottom might be forming. Now, before you run off and start looking for these everywhere, we need to talk about something that's absolutely critical. Not all time frames are created equal. So here's the deal. The higher the time frame, the more you can trust the signal. It's that simple. A divergence on a daily chart, that's a big deal. It filters out all the random day-to-day noise. But a divergence on a 5-minute chart, it's often just noise. You'll get tons of false alarms that can trick you into bad trades. So daily and hourly charts are where you'll find the really reliable signals. This right here is the golden rule. Seriously, write this down. A signal on a higher time frame carries so much more weight. When you see a divergence on a daily chart, you need to sit up and pay very close attention because the potential move that follows is usually much, much bigger. And this slide really hammers that point home. Trying to trade divergence on short time frames is just chaotic. The moves are tiny, the signals are unreliable, and it's almost impossible to find a trade where what you could win is worth what you might lose. Stick to the higher time frames. You'll get cleaner signals and a much better shot at consistent profits. All right, so you know what divergence is, you know how to spot it, and you know what time frame to use. Now for the fun part. How do we actually build a trade around it? Every good trade has 3 parts. First step, your entry. Now, don't just jump in the second you see a divergence. Be patient. Wait for a confirmation candle, one that actually closes in the direction you expect the price to go. That's your proof. Second, your stop loss. This is your safety net. You place it just below the low of that confirmation candle. And third, your target. Just look left on the chart and find the next major area where the price has struggled before. That's your resistance, and it's a perfect place to think about taking profits. And this might just be the most important rule of them all. Before you even think about hitting that buy button, you have to do the math. Is the amount you could potentially win at least twice as big as the amount you're risking? If it's not, you walk away. No exceptions. This kind of discipline is what separates the pros from everyone else. Okay, last but not least, let's talk about the bigger picture. Because as powerful as RSI divergence is, it's still just one piece of a much larger puzzle. I want you to think of yourself as a detective building a case. The RSI divergence, that's your star witness, a huge clue. But it's not enough to go to trial. You need more evidence. Is the price itself confirming the move by breaking a key level? Is there a big spike in trading volume backing it up? And what's the overall market doing? When you combine all these factors, you build a much stronger, more convincing case for your trade. You never, ever want to trade on just one indicator alone. So, as we've seen today, RSI divergence is way more than just a squiggly line on a chart. It's a window into the underlying battle between buyers and sellers. When you learn to spot it on the right time frame, confirm it with other signals, and manage your risk like a pro, it can give you a serious edge. So the only real question left to answer is, could this be the missing piece in your trading plan?